On today's edition of The Final Bar, we'll talk market sell-off in the morning, market recovery in the afternoon, the big news from Apple, and all the movements happening in between. In a segment called Shifting Stocks, we're going to break down all the moving pieces, what names are in focus as we continue to process earnings and different announcements. Also, my guest is Jim Smith from Gann Analysis. Jim is a Gann expert, which is a different toolkit for many of us, so it should be interesting to hear what he has to say about the big picture going forward. So, ladies and gentlemen, this is The Final Bar. Hello there, welcome to our show today, The Final Bar, here on a Tuesday afternoon after a long holiday weekend. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining me every weekday after the close to look at today's trading from a technical perspective, link it to the long-term trends, try to have a proper long-term perspective about how today's trading fits into the big picture, which I think for long-term investors is always the challenge. Unplugging from today's headlines, today's themes, and try to think a little more longer term about trends and momentum and the evolving landscape of equities and other asset classes. So quite a bounce around today. We had sort of that sell-off into midday, and then the afternoon was this stepwise motion going back, still finishing in the red though. And so we're going to talk about some of those themes, large to mid to small, that we've been reviewing. What concerns me at a high level is basically all of these bearish divergences that I'm seeing. And when I was putting the 3 and 3 together today, those are three charts that I think are worth paying attention to. Three bearish divergences to keep in mind. Great show coming up today. I did want to highlight some of the upcoming events on StockCharts TV, also on this show. So we have Jim Smith today, Gann analyst. Tomorrow we have Leslie Juflas, who's the author of Trade What You See, a fellow Seattleite who's going to join us tomorrow. Sam Burns from Mill Street Research is going to be on Thursday. Next week on Monday, our next episode of Behind the Charts is going to feature Craig Johnson, who's the Chief Technical Analyst at Piper Jaffray in Minneapolis. Had a really cool conversation with him about his process and his background. You're going to want to see that one. Then after that, on March 3rd, we have Scott Smith from Briefing.com who's going to join us. So we really enjoy bringing guests onto the show, hearing their perspective, and I'm really excited for Jim's comments later. Jim focuses on Gann analysis, which is a toolkit differing from my own, which is I've always enjoyed hearing what he's seeing. Hearing what he's thinking. Let's get to our market recap. So when I'm looking at the market today, when I'm bringing up the member dashboard, just looking at the last couple days, here's Friday's session with the sell-off and then the rally into the close. Today we had the distribution going into midday, and there's the news over the weekend about Apple. There's the longer weekend, which I was thinking gives everyone one more day to process potential coronavirus issues. What is that going to happen, or how is that going to impact the markets today? And we certainly saw more distribution than accumulation going into lunch. But after that, sort of had this stepwise motion back upwards, right, with overall some net accumulation. But the last 30 minutes, you can see, really was more profit taking, more closing out the session. So large caps in the form of the S&P up just under 1/3%. The mid cap index down a little more, small caps down the most. So certainly was sort of that defensive posturing during the day, with smalls leading the way down today. Let's look at chart of the S&P 500. And so this line I put on here last week, we were talking about this non-confirmation of higher highs in the S&P, lower peaks in the RSI. That's sort of evolved a little differently, right? We've still sort of put in a lower peak on the RSI, but it's come up a little bit. And now this is what a lot of the charts look like, sort of this pattern of lower peaks in the RSI, higher peaks in the price. And so the question is that become validated? Do we have some sort of breakthrough of support? And for something like the S&P, I think first off, you have to, first line in the sand is now 3320, which is the low from the beginning of last week. That's last Monday session, which was sort of that launching pad, that bullish engulfing pattern that took us a little bit higher. 33.20 would be the first one. After that, you have the 50-day moving average, which was around 32.60, and then below that, 32.10 has been really the key line. That's taking the low from 2 times in January, also the end of last month. So, overall, still obviously very constructive. Today's trading was just within the range of the last 4 trading sessions. So overall, really not giving you a net movement one way or the other, sort of narrowing of the range within that overall trend. In terms of some other themes, you'll notice utilities, communication services up number 1 and number 2. Those are the only 2 S&P sectors that finished in the positive. On the downside, you actually had financials leading the way down. And later when we have a segment shifting stocks, I did want to talk a little bit about some of the bank charts, things like Bank of America, JP Morgan, all starting to pull off a little bit. Other things maybe in more of the I think it's the financial services group. Things like Goldman Sachs are starting to break down even a little more so. So let's look at some of those charts and think about what that means for the broader implications with the financial sector. Looking down a little further, you can see in terms of global ETFs, the China A-shares ETF was one of the few that was up big today, followed by Italy. So not many. Most exchanges were down a little bit, and a lot of Asian ETFs actually led the way down the most. South Korea, Taiwan, Brazil, also with a very commodity orientation, was down pretty significantly as well relative to the U.S. markets. Looking at industries, though, you have automobiles on the way up, and this group has done overall very, very well, driven primarily by Tesla and the strength in that chart. But I thought it was also interesting to note gold miners, mining as the group. Those 2 groups were in the top 5 today, which is actually kind of interesting. If you look at the gold mining group, and again, it's not a super broad group, and we'll look at Newmont Mining here in a second, but you can see this really compelling setup here, right? Sort of this longer-term uptrend, this basing pattern, breaking above resistance here from last August, now pulling back to an ascending 50-day moving average, and then today we sort of bounce above there. So a break above 106, which would take us above the highs from the end of January, could be really, really compelling. Newmont Mining is right here, NEM. You can see it's setting up pretty compelling chart here with, this one is actually testing the closing highs, all-time highs here from the end of last month for the last year. So, really interesting setup actually in gold miners. You think about what that means with the broader market. If gold mining stocks are doing well, what does that mean for the broader environment? Now, again, always be careful. Don't draw tons of conclusions just from one day. A trend is made up of a lot of days like this. So if you continue to see gold mining and miners up here toward the top of the list, then you want to start to think about the implications of a longer-term trend. On the downside, interesting to note, you have a couple technology groups. So electronic equipment, also computer hardware. This is Apple's group, and so sell-off in Apple is certainly going to drag that one down. So down about 1.75%. Again, it's sort of been choppy. It's not in a big downtrend. It's still toward the upper end of the range, but certainly a gap down today. And then banks at one of the worst groups today is concerning because all of a sudden, the chart of the banks index is looking a little bit more like sort of a bear flag, which is where you have a sell-off, you have a rally, a parallel rally of higher highs and higher lows, which is a counter trend or counter trend move to the larger trend. Usually, that's a pause before an equal move down, which would put this down in the 460, 450 range, which would be a pretty brutal sell-off in banks relative to where they've been. Also, what's interesting about the banks group, and we're going to, in a minute, dig a little deeper in here. What's interesting is you've seen the RSI not get above that 60 level. It's sort of stayed firmly in the bearish range, and this is when a lot of stocks and a lot of groups are overbought, if not extremely overbought, sort of at the upper end of their channel, testing new highs. So it shows you that on a relative basis, banks are actually incredibly weak. If you look, they were here flat to the market sort of mid-December. There's sort of, you start the clock there, they're down almost, just over 9% in 2 months, which is, that certainly hurts on a relative basis. I did want to show one final chart before we go into our discussion of shifting stocks, which is looking at the bond market. So we talked about fixed income. This is one of our 3 and 3 on Friday. I thought it was worth noting the TLT up again today, sort of chopped around and closed not too far from the open. But overall, this is looking more and more like a bullish pennant where you have this nice rally, sort of this consolidation. Again, don't worry about, I really don't care about the fact that it's called a pennant as much as others might. I'm concerned, or I'm focusing on the fact that this is an equilibrium, right? We've decided this is about the right price right in the middle of this triangle pattern, and then when we break out, it's telling you the momentum is taking hold to the upside, and a break, really a close above 146 would really validate that push to the upside and suggest higher bond prices, weaker bond yields. We need to move on to our next segment, shifting stocks. So what I like to do with this segment is to talk about some of the themes that I'm seeing within the equity landscape. And as you may have heard from when I've talked about on the show, every weekend I try to go through all the S&P 500 charts and just look at themes, look for patterns. And it's a great weekly process of just internalizing what you're seeing what groups are working and what aren't. So a couple things I just wanted to highlight. Kroger was actually on our list of movers today, and I just wanted to highlight what the chart look like here. We actually don't have Kroger out here in Washington State. We have, what do we have, QFC, which I think is owned by Kroger or something like that. But you can see it's interesting. You have this gap up today, and you have the real choppy, real volatile trading. The range was pretty wide today relative to what it normally is, but we didn't go very far from the open. We sort of gapped up and then sort of settled into that same thing. So it wasn't sort of a long and strong dramatic break to new highs. It was more like a yawner, kind of jumping up but not really following through. So with a chart like this, it's up big, which is great. It's at new closing highs, which is great. It's broken above resistance, which is great, but now I would want to see some sort of follow through. And anytime you have a big move, especially from something like earnings, it's all about the follow through days. It's all about what tomorrow does. Now that we've had a chance to digest what we heard, what's the next step? And again, I'm not sure, just given on what happened today after the gap up, it certainly didn't feel like bulls were taking dramatic control and trying to push this much further. So I'll have to see what sort of follow through we have tomorrow. What I did look at this weekend were, looking back at the FAANG names, a lot of the FAANG stocks sort of jumped out at me as interesting charts to go through. So I wanted to just walk through some of those very quickly to see where they're at. I feel like the only charts I looked at for a while, maybe a year and a half ago, were the FAANG charts, because everyone wanted to talk about the FAANG trade, and if I would be interviewed, they always would want to talk about FAANG and what they were doing. So I've looked at them less regularly than I used to, but I think it's worth following where they're at for sure, just because of the weight in all these names. So, Facebook is an interesting one. It is in a bullish configuration, above 2 upward sloping moving averages. The problem is it's sort of below the previous highs. It had this, gap down. It closed at a new high here at the end of January, but then jumped lower, and now has sort of been teasing this 50-day, sort of following it on the way up. Now it appears to be rallying back toward the highs. And I think what's interesting about Facebook, what caught my eye, was that the RSI is just below 60. And again, if this is switching from a bullish phase to a bearish phase, you wouldn't expect the RSI to get much above 60 on sort of a counter trend rally, right? What a counter trend rally should look like is a nice break higher. The RSI hits about 60, and then it starts to roll over. Kind of what you saw back here last September. So the question is, are we in this sort of environment before the next leg down? Or is this, a continuation of the uptrend? So I think where we're at right now, particularly what the RSI does over the next couple of days, will be very interesting with that chart in particular on Facebook. Apple is an interesting one. Obviously came off a pretty good amount relative to other things, and as a result, it's dragged a lot of things down. What caught my eye with the Apple chart, 2 things. Number one is this bearish divergence is really glaring. So if you look over the last 6 weeks, the RSI has been successively lower peaks, right? So every time the market comes up a little bit, lower peaks in the RSI, and that's sort of what market tops tend to look like. It's not saying it's going to top, because a lot of times the market could continue higher, but tops tend to look like this, which is what it's interesting to me. I also would pay attention to the relative strength here. It's testing a new relative low for the last couple months, and we have to go just a little bit further down to have the relative strength line go lower. And the problem with that is if you're a big institution trying to beat a big benchmark, you want to own stocks that are outperforming. You can't own a huge company that's underperforming, where it's really going to hurt your performance. So if that starts to sell off, you can see things capitulate very quickly because people have to get out of a name like that. Continuing on our list of the FAANG stocks, Amazon is certainly one of the best. Now, this is a little different because most of these are in the internet group within technology, but Amazon's not. Amazon's in consumer discretionary, and you can see it's had this nice breakout above resistance from last July, gap up that's now followed through, and now it appears to be this nice pullback after an extreme overbought condition, which overall is setting up very positive. That's one of, I would say, the most constructive out of the 5 charts we're going to look at very quickly here. Netflix is next, NFLX, and as you can see, this one's an interesting one because we're sort of testing that long-term high here. I'm going to bring out another year of data in. Now you can see the peak from June, July of 2018, the sell-off into the market low Christmas Eve 2018, then the rally back, and we set resistance just below 400. This is around the 385, 390 level. We've now round-tripped. Look at how quickly that's, I mean, not how quickly, but how dramatically that's happened, right? All of a sudden, it's testing the lows from the market bottom, and now it's come all the way back and testing this resistance. So this level right here is huge, and that 390 level, I think, is really significant. That would take us above the peaks from last summer a number of times. It also lines up with the peak from fall of 2018. So at a really key juncture, right as it becomes overbought. So all else being equal, this happens in a vacuum. You'd expect at least a little bit of a pullback as it's approaching resistance and it's overbought. So whether that happens with Netflix this week, I think is going to be a key one. And then finally, just to finish off our look at the FAANG stocks, Alphabet is a really compelling chart because it's gone higher and it's new intraday highs today, new closing highs in the last week. But you can see that the RSI is much, much lower than it was at the beginning of January, that big push in the first couple weeks of the year. So this is one of the many charts showing that potential non-confirmation, the lower peaks in momentum with the higher peaks in price. So I think all 5 of these are interesting to watch right here. And again, because so many eyes are on them, if you start to see the divergences play out, if you start to see them topping out where we've talked about, I think that'll tell you a lot about the characteristics of what's happening here. Just a couple other groups to highlight as I'm thinking about stocks shifting around. Homebuilders are a really interesting group right now. A lot of these are reporting earnings in the next week, if I remember. I think Toll Brothers is next week, if I remember right. But looking at this chart, this has not had much of a divergence, but you can see it's had this nice rally, higher highs, higher lows. It's arguably pulling back with the RSI similar to where it was at the end of January on the most recent pullback. Almost feels like it's trying to hook around for the next leg higher. The 2 ETFs you can look at within homebuilders are so super confusing. So just to finish off, XHB is called the Homebuilders ETF, but it's actually a broader look. It includes things like Home Depot and Lowe's and other home construction names. ITB is a purer read on the homebuilders, and it's confusingly named the Home Construction ETF. So go figure that one. If you watch the Behind the Charts with Eric Balchunas, which aired yesterday on StockCharts TV, he talked about being aware about what things are where. So I'd encourage you to look at the construction of some of those ETFs. And just very quickly, so sorry, I know we're out of time, but I did want to highlight the bank. So the XLF is what concerns me. It's down one of the worst sectors today. Something like Bank of America actually hooking lower peaks. The RSI is lower. It certainly feels like it's establishing a lower high and overall in a position of weakness. So market holding up, but with banks and financials, regional banks, others in a position of weakness. So a bit of a concern here going into this shortened holiday week. That's our segment on shifting stocks. So many interesting themes. I encourage you to look through some of those charts on your own, draw your own conclusions. We're going to take a brief break and be back with my guest, Jim Smith. See you in a minute. Everyone, welcome back to our show. Please keep your questions, your feedback coming to us. The final bar at StockCharts.com is the best way to send questions our way. We'll do a mailbag segment later this week. We'd love to answer your own questions, so shoot us an email, or during the show, just put a quick comment in the Q&A segment. We'll make sure we capture those and address them in a future broadcast. I want to welcome on my guest, Jim Smith. Jim is a Gann analyst, someone I've followed for a number of years, actually, coming to us live from Texas. Jim, thanks for coming on the show today.
Well, thanks for having me on the show.
So as I mentioned, I've followed your work for a number of years, and what I've always enjoyed from talking to you is that your toolkit is so different from mine. You focus on Gann analysis, and the first chart you sent me is a monthly chart looking at gold. What are you seeing here?
Well, just to explain to your viewers and your listeners, the low there in October 2008 and the high in September 2011, that is what defines the square of the range. We're defining it square of the range by price, and we set the scale to 10 points per month. So that means that from the high, that big red line coming down diagonally, it's going to decline. The slope is going to be 10 points per month. And you might notice that first lower high caught the one by one caught the lower high. And the green line above it would be called a 1 by 2 because it's half the slope, or 5 points per month. And the green line below it would be twice the slope, or 20 points per month. So those are the major lines to concern yourself with. And what you're trying to do with Gann is find the rhythm of the market. And a lot of people ask, well, if you can change the scale, doesn't that make it subjective? Well, that's an oversimplified view of it. The reality is, if you're getting a lot of hits, you've found the rhythm of the market, you've found the right scale. And if you look at this chart, 1/4 of the distance through the square, you can see a high. And then halfway through the square, you see a low. And 3/4 of the way through the square, you find a low. And if you're getting hits like that, you know you're on to the right scale. And if you look from the high, the 1/4 division down from the high, you'll see a number 1613. We hit that exactly a few months ago. It looks like we're going to test it again here shortly. Keep in mind, this chart is not updated for today's price action. We got to 1605. So we're knocking at the door. And my view is that if you close above 1613, after having tested this area a couple of months in a row, you're probably going to get a fast move higher. There may be a panic buying situation. And so I've been alerting my clients to this chart. The value of this chart is, if you already have a position, you might want to add to it when you get above 1613 on spot futures. So that's how that works. Sometime in 2021, you complete the square. I think it's, I should have put the time on there, but anyway, that the square is valuable in that it tells you when to look for a change in trend. So halfway through the square, you look for a change in trend, 1/4, 3/4, and the completion of the square. Although those are valuable in time, so that gives you a time to look for possible change. And also the price divisions, like this 1613 is quite valuable.
It's interesting. What I've always loved about your work, Jim, is it deals with the relationship of price and time. And I find so many analysts focus on one of those, right? They focus on price, relationships, or they focus on time and the cyclical nature. And Gann's work has always struck me as it combines the two in a meaningful way. Now, the second chart that you sent is also looking at gold, but a little different take. How is this relating to your first chart?
Well, a lot of people roll their eyes when they think about the planets and the planetary lines, but all I say is, the proof is in the pudding. If you see gold is forming a higher low last September, and then you see another higher low, actually a year ago in September, and then you see another higher low in the spring. I've marked with circles every place that you have these higher lows. It seems to bounce off the planetary line of Saturn on a regular basis. So all I'm really saying with this chart, those little pink 1, 2, 3, there's a nice pattern there. After you bounce, you skip 3 lines, you form a high, and the beauty is that the same line that gave you the high last fall is now offering support. So if we skip 1, 2, 3, if we follow the same pattern, it would imply a move to 1824. Now, if you start your count from the lower level, maybe you go to 1736. I would just say to clients and to your viewers, keep an open mind. See how it reacts when it gets to 1736, 1824, 1916. Effectively, you get above 1916, you're going to new highs. But all I'm really saying here is you can see a pattern on this chart. And if it seems to be working, why not use it? I have to admit, the first 10 years that I studied Gann, I never looked at the astrology stuff. The planetary lines, I had the same view that other people did. But then once I started looking at it, you can see that it is a valuable tool, and you can see why Gann made active use of it. It's not his only tool. I think the guy, he obviously did a lot of different things, but it's a very, I think this particular chart is very useful for gold because it is obviously responding to the planetary lines.
Jim, these are 2 really interesting charts. Number one, thank you so much for coming on the show, and thanks for just sharing us a little glimpse into Gann analysis. 1613, I jotted down. That's a really interesting level to pay attention to that we're just at. So, an important one to watch. Jim Smith, thanks so much for coming on the show today. We really appreciate it.
All right, thanks a lot for having me.
That was Jim Smith from Gann Analysis. I've always enjoyed talking with Jim to get his take. And again, what I've always found, 2 things that I've always followed. Number one is be very confident in my own toolkit, which I would say I am. And number 2, surround myself with people that have a different toolkit to see what they're seeing relative to my own. And that's one of the things I've always enjoyed hearing from Jim is relating what he's seeing to what I'm seeing using other more conventional methods, perhaps. So 2 interesting takes on the chart of gold, which is very interesting. We need to wrap up the show, folks, though, by going to the 3 in 3. So at the end of every show, 3 charts in 3 minutes. If these are not on your radar yet, I hope you can add them as of right now. There's a theme to these 3, and as I was putting them together, after my weekend chart review and then sort of prepping for the show today, the divergences keep jumping off the page at me. And again, I think it's maybe just because I started in June of 2000, after the March 2000 peak, and felt very confident in 2007 the market was going to top, and then was dead wrong in 2013 when I thought the market would top again because we hit that same level. I'm sort of always looking, when the market is rallying, I'm looking for signs that might be exhausted, looking for signs of trend exhaustion. And 3 charts that I think are sort of adding up, suggesting that might be the case. And they all relate to bearish divergences with price and RSI. So the first one is the Russell 3000 ETF, ticker IWV. We look at the spiders a lot in the S&P index. We've looked at the Russell 1000, the Russell, the S&P 100. These are all very, very fine. And the Russell 3000 doesn't look too different, but it basically combines the Russell 1000 of large mid-cap and the Russell 2000 of small-cap names as one big universe. So similar to the broader indexes, but I thought it was just a very clear bearish divergence here. At the higher peaks in the last week here, looking at the IWV reaching 198 and lower peaks in the RSI with that lessening of momentum. You can see that it's essentially been the market for the last the last quarter or so, maybe 4 months. But overall, this bearish divergence, I think, is concerning for the overall market environment. A lot of individual stocks are seeing a similar pattern, but you're also seeing it in other places. The QQQ is my second chart, and you can see the same issue, maybe even more glaring because of the acceleration to the upside. You might not have noticed the QQQ has really outperformed. There's obviously a big, focus on tech and sort of new economy names in the Qs, but you can see how the outperformance has accelerated. It was sort of a market performer through much of last year. A lot of that outperformance has come in the last 2 months when it's really outperformed by 6-7%, outperforming the S&P over that time period. But it's also facing this bearish divergence. You had the extreme overbought condition 3rd week in January, which came off. Then you have that next rally. We've not reached that RSI level of 80, which means it's more of a bearish divergence. And then the third chart which is a really interesting one, is actually Toll Brothers. We looked at this earlier, and I think, not as much of a divergence on here, maybe a little one, but what I think is interesting here is, I'm always looking for lines in the sand. At which level might you expect that an uptrend is exhausted? And I would think if a stock like Toll Brothers breaks down through this trend line, which is taking the lows basically year to date, one of two things is going to happen here. Either the RSI hits a bottom similar to where we saw the end of January, it hits the trend line support, continues on to new highs, and the relative strength finds support and goes up, or we are really close to a breakdown of price support, a breakdown of momentum, a breakdown of relative strength, and the three of those would tell me to be a little more cautionary about the prospects of home builders. And ladies and gentlemen, that's our show for a Tuesday after a long holiday weekend. Thanks so much for joining us every weekday after the close. Check out our YouTube channel if you would. Make sure you hit subscribe and get notifications, because we'll be doing a YouTube live Q&A this Thursday, 10:30 a.m. Eastern, 10:30 a.m. Local time here, Pacific time, 1:30 p.m. Eastern, to answer your questions about the markets. I want to thank my guest, Jim Smith from Gann Analysis. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.